Hey, I'm just doing this, so if someone's having a problem laying into something. Oh, my microphone is. Oh, I push the button. It works about 100 times better. John is having a problem with his with the position he didn't manage. Man, you were quick. All right, there. Let's see. Discard. Sorry. So let's see. Is the audio okay? It's super hot for me here, and I've got the air conditioning like right next to me. So hopefully this is okay. Thanks, Pedro. Man, I didn't expect a couple people to pop in so quick, but yeah, today was actually this week's been a pretty decent day. I want John to get in here. He left a message, so he's trying to figure out. Basically, he was in a call credit spread, and he didn't manage it, didn't pay attention, and then it went super far in the money, and so now he's like super upside down, right? Like it's expiring in a few days, and AC isn't too loud. Cool. Thanks. So basically super upside down, and it's on Shopify, which I hadn't looked at Shopify, so I was just looking at it right now, and obviously it's been pretty crazy rip up, and he's into that call credit spread around the low 1300s, and now it's ripped up $200, and so he doesn't have much. He has like nothing left in the spread, and then so I told him like you should leg into a iron butterfly, and then I was figuring, hey, maybe he didn't exactly understand it, so I just wanted to show what that looked like, and then for whoever else needs to ever leg into something, it is super handy to have that kind of in your back pocket. So when you're opening up a put credit spread, I'm not sure if you guys know this, but when if you're doing a put credit spread and you have collateral out there, so you have you have your $500 or $1,000 worth of collateral out there, you can open up an iron condor for the exact same collateral. So like, let's see, let me clear this out. So like, well, it's way up there now, but let's say you had a put credit spread on, and you're way down, whatever, 1300, and you've already put up this $1,000 collateral. So you already have to put up the $1,000 to be able to sell this thing with a difference between 1300 and 1290. You can go to the call side, and you can sell a call credit spread and collect a little additional premium that turns it into an iron condor, and you don't have to put up another dollar. So you can always do that absolutely 100% for free. It doesn't change your collateral at all. So it's probably always really good to do. The reason that I don't do it with the Tesla credit spreads is just because on the high side, for me to be up far enough, I'm collecting so little, and then the downside of it just makes it a pain in the butt for me to roll them out. And you guys see how often I roll them out, like, it could be a few times a day. And with Robinhood, since you can only move 2 legs, so you can only do like a 4-position move at one time, I can only move a put credit spread. Like if I wanted to move an iron condor out, that would have to be 2 separate moves, and that's why I don't do it like that. But it's super hot, so I'm having some Johnny Walker Black, so I hope you guys don't mind. It's my last. So anyways, he's already into, and we'll take a look. The position that he's actually in, I believe, was on the call side, was a want to say a 1320 and 1330. So basically, he's pretty much, as far as that call credit spread goes. Let me make sure I have these on the right side. Yeah, he sold the, okay. Yeah, let me make sure I have those right. So pretty much, like, essentially, with this position, he's pretty much screwed right now. So the cost right now is, you can see it's $10. Let's see, make sure, yeah, you can see that. So it's a $10 cost to be able to close this thing. So he had $1,000 credit and going to have to pay as much or more to be able to close it. So basically, there's $0 left, and the way you can leg into it. So what I said is basically you can go ahead and sell the put credit spread right there, and turn this into a butterfly. And if you were to open up all 4 of these positions at once, you'd be opening up an iron butterfly. If you go back and do it, it's just called legging in. Different people call it different things, but all you have to do is go to the put side, and in this instance, since like I don't think there's any chance Shopify is going to drop from 1,500 down to 1,300 and some in 3 days. I don't know. Maybe maybe some of our governmental agencies can do something like that, but essentially, since it costs the full $1,000 to close, there's no money to collect there. So he can go to the put side and sell at that same strike price that he sold the call, that he was short on the call, and go short on a put, and then buy the one below it. Let's see, where is that one at? That is going to be the 1310. And so we'll get rid of the other one. So you can see it's just like a $7 credit, and that's it. It's just like if you're totally screwed anyways, you don't understand the title, but you're here. Cool. I actually did this this is directly for one person, but hopefully somebody else can benefit from it. Yeah, what we're talking about is basically if you have a put credit spread open or a call credit spread, you can always open up a second position and turn it into an iron condor or an iron butterfly for no more collateral. And so it always makes sense to do so. Like, you're just adding a little bit more money to what you have. So like in his case, he's already screwed. He can't gain another $1. He's not going to be able to close that thing without giving up the full $1,000. And if it expires in the money, which 99.99% chance it will. I mean, I guess we can see it, right? If we sell it, we can see well, it says there's a 2% chance that it could come back. But if Shopify does not drop that $1,300 and some dollars, then basically there's no chance of making any money at all. So might as well sell the put credit spread and collect a few dollars. It's really picking up just an extra few dollars. And if you would have done this, a lot earlier, where extrinsic value was more. So, for example, if this was still a couple weeks out and that crazy move happened, in that case, it would have been better to leg into an iron condor to make it like a little bit wider. I mean, this Shopify move is pretty insane, right? Moving, what did it move? Like $200 this last week, which is pretty nuts. If it hadn't moved that far and you're still like in the money, you can open up this other side, and then you can see what the profile looks like after. Let's put that back. The call and the 1330. So you can see basically what's probably going to happen here. Like all this whole area, there's absolutely, there's nothing. This is all 100% loss, except for this little bit of island here, right? Where this, you he could make the full $1,000 back if it happened to drop down to 1320. That's a butterfly, right? It's a, when they're usually opened up initially, they're a high risk, high reward position. This if it's open initially, could be it's $100 into 1,000. That's actually the Tesla positions that I have. Those let's see. So this is actually what this position, I don't know if they show, no, they don't show the graph afterwards, but basically this is an iron butterfly. So same kind of thing. Basically I sold calls and puts at the same strike price, the 625, and then these are a little bit wider. He had a $10 wide strike, but these are a little bit wider. But for the cost, 23, let me calculate that. I can't remember. It was like, I opened this up for like, $300 or something, and my max gain is about 1,000 just on that. But yeah, Shopify's move was absolutely nuts, and I hope John jumps in here. I'm gonna message him real quick. What is she doing? Oh. Oh, it's funny when I chat with some people who don't speak English, and then they have to put my text message, they have to copy and paste it into like Google Translate to understand, and then put it back. Then she'll write something. This girl writes stuff in another language and then translates it back. So sometimes she accidentally copies and pastes my same message back to me. But let me just make sure. Let's see. All right. Man, only Tuesday. You guys' week been pretty good so far? I just hoping John jumps in here real quick just to make sure he 100% understands it, because he has to deal with this and manage it tomorrow. But I guess there's always the replay. But is like, as far as like you guys listening to that, does that make sense about legging in, or did you already know that you could do that? Do you know the same collateral? Do you know like the same collateral you put up for any kind of credit spread? On one side, you can open up a free iron condor. It's zero extra cost to you. And actually, it's pretty good, right? Because if it moves against you, you still collect from the other side too. And that's why for a while a stock is definitely like volatile, or not volatile, when it's being a little bit less volatile, like Tesla's been kind of calm, and I'm definitely waiting for this next, we have another week till the end of the month, and then we have 3 weeks until earnings after that, so that's why I'm scared of the upside. Cool. Well, Pedro, at least you learned something. So if you're, every single time, open up a put credit spread, you can open up an iron condor, exact same. Yeah, and that's exactly why, Jacob, which I didn't talk about, the reason that you don't have to put up any more collateral, because you cannot lose on the same expiration date. You cannot lose on a put credit spread and a call credit spread. You just can't do it. So you only need to put up the maximum. You can do them the same width. You could do them, one a little bit wider. So whatever that the greater strike price difference is, that's the one you have to put up. So you can do, a $10 on one side, $5 on the other. You're going to put up 1,000. But if you do $5 on each side, then you're going to put up 500 for the iron condor. Collect a little bit more premium. So, like for all my, my Tesla credit spreads, don't know, what did I open today? I actually rolled some out today because it's doing pretty well. But, you know, go out a month, and so, you know, somewhere real easy that I like to be, you know, maybe like the 560s, 555s, and I can get $125 credit for this one. But then it's kind of like I might as well, I can go and this is going to require $500 credit, and then I might as well, I mean, I have to find a $5. That's one of the problems. Like you do need that same width, or you're going to be paying more. Yeah, this is a terrible example because it doesn't have anything that's a $5 width. But July 23rd, of course. So we'll do the example with this one. 560, 550, $10 width, and then I can come up to the call side and I can do something super far out of the money to where I'm not even worried about it. You know, like it's probably not going to hit 950 or something like that. And even though, so I can grab 30 cents for this, super far out of the money. And then I might as well, it's like I might as well add this leg, and I grab another $4. So it's, you know, it makes it a little bit more difficult to close sometimes. I don't necessarily, like, for me, that extra $4, I'd probably, I mean, that's probably a bad example because it's so far out of the money, but an 800 would probably be more realistic. Total cost $4. What am I doing wrong? My gosh, sorry, I'm new here. Sell that one, buy that one. Why is it only showing 4? Sell, buy. Something's messed up there. I should just clear it out. Start again. I'm not sure why I did that. Let's try again. And let's go out. July 16th. Go to our puts. So I'm getting a little bit more proficient on actually using the desktop version. All right, we'll go $10 width here, collect 75 cents on the put side, go to the call side, go somewhere where I don't think it's going to go, maybe a 750. And then we collect that extra, what is that, 25, 35, 44 cents. And it doesn't cost me any extra collateral. It's still the same $1,000 collateral on it. So I don't know that. I wonder if John's gonna make it or not. Well, he can replay this, since I think we talked through it enough. If you guys now know and understand, then you should be able to watch it back and check it out. Yeah, love iron condors. Yeah, that's the only reason I don't like them is because it's probably because of the stock that I play, because of Tesla, and I'm always scared of that upside. And I think that's the only reason that I don't always sell the call side. I was for like a little while on the way down, but right now, coming into earnings, coming into production numbers, I'm just scared of that upside, and then I have to sell it so far out of the money that I'm only collecting $4 or $5 or something like that, and then it makes it a little bit more difficult to close. So that's the downside of it. But in his case, where everything is super far out of the money anyways, it just won't matter at that point. It's all going to expire worthless. What do you rate the wheel strategy on... Wait. What do you rate the wheel strategy on underlying you're bullish on. You like? Are you asking me like, do I like the wheel on a stock that I'm bullish on? Last year would have been difficult. Last year would have been difficult, and this year was difficult. It would have been difficult all through that volatility. Yeah, the indices are the best. That's a smart move. It's just not as much premium there. No, and I'll tell you why. I don't like the wheel. There's definitely some good sides to it, and I think like long term the wheel is fantastic. You have to two things. You have to like the stock enough to where you're willing to get assigned. But the problem I have with the wheel the majority of the time is the selling the call. If it's a stock that I'm bullish on and I already think it's going to go up like significantly, I guess it depends like what my outlook is. Is it something that's like really slow moving? Do I expect it to gain like 3% throughout the entire year, or is it a growth stock? And for me, it's mostly growth stocks that I like. And if it's that case where it's a growth stock that I like, then I don't want to get the shares called away from me. And that's why I finally did. I am running the wheel now on Tilray, which is a stock that I don't mind owning, but I also don't care if I don't own it. Like it's not a big enough like attachment or anything to me. So I think it's, I'm not like super pumped to own weed stock. It's not my thing. But that's when I got started last week. And so I sold my puts, got assigned, and I'm perfectly fine with that. Selling my calls, if they get called away, like fantastic. Like whatever happens. Just don't care. So I think the wheel's good in that case. But the underlying like has to fit that criteria, because you're asking me like, how do you avoid being assigned when you sell calls? You're almost never, it's possible that you can get assigned, but like before expiration, if you're really worried about, like, you can roll it out, so you can roll it out, you can roll it up. But if it's a stock that moves, so like Shopify, I mean that's a perfect example of like, if this was a stock that you wanted to own, and you're down here at 1350 at the beginning of the week, you sell a call on it, you're probably selling it at 14. I mean, if you were to sell it at 1500, you're probably not getting a stitch of premium. So you'd probably be selling it when it's at 1350, maybe selling it at 1400. Not, I don't know how this thing's moved. I mean, because it's been kind of dead for like a little while, or when it's around 1200, and then you sell it for $1,400 to try to get a decent amount of premium to make it worth it, and then all of a sudden it rockets up, you get the shares called away from you, and then now it's $1,600 and you can't buy them back. That sucks. It sucks. And that's where I don't want to be in the position, because almost everything that I own, I love. Like, I'm attached to most of those companies. Like, they are shares that I don't care if they go down 40%. It just doesn't matter. I want to own those long term. Awesome, John, you're here. We already kind of went through everything, but I'll go through it again. So, basic question here: how do you make the max profit when with spreads? Is it selling spreads or exercising the options on expiration? It's going to be the same. It's going to be like exactly the same, because I know I have like 10 million videos. It's ridiculous, but if you find the one about intrinsic and extrinsic value, that'll explain it to you. At expiration, you have no more extrinsic value, you have all intrinsic value. So the only value there is what it's worth between the strike price and the stock price. So if you exercise it or if you let it expire, it's going to net out exactly the same. So might as well just let it expire. I mean, well, I guess sell it. Like if you have an option that you can exercise, you would either need to have enough money to be able to exercise it and buy the shares if that's what you're after, or sell it. I mean, and most of the time, like if you're messing with like Robinhood, they'll automatically close it for you. Anyways, they'll sell it for you because if it's at risk of expiring. I show how to. For me, did a video where you show how to find a good stock to trade an option for. I don't think I have a specific one like that, or how to find one. I talk plenty, and I stream every weekend, not usually during the week, but we're trying to help out John here or explain this. So, and I talk a lot about stocks I like and why, but yeah, and we can definitely talk through that on like a Saturday or something. But I don't have one of those specifically. So, John, so I kind of went through this already, but let's see, where were we at? So let's look at the options. So I don't know if you already know what an iron butterfly is, or butterfly looks like. So basically, you're in this guy right here, which is let me just make sure, did it on the calls. Okay, ball inside. So basically, like you're all over here and you're already screwed. Total credit is 1005. So I don't know what what is showing on your Robinhood, but it probably shows it cost you like $1,000 to close it. So like there's not a dime left. So an iron condor looks like this. It's basically the same. Or did I say iron condor? An iron butterfly looks like this. It's that same call, that same strike price that you sold the call at, you sell a put at, and then let me make sure I click sell, and then you buy the one beneath it for the same width that you had your call credit spread, and this is what a butterfly is going to look like. It's like super steep. And well, I said don't get excited because it's super low, and since it probably, like, you're probably not going to be able to close that thing, and you can definitely try to collect $5 or $10 and close it early, but I would expect at this juncture with it being so deep in the money, like you're saying, that you may not be able to get anything from it. So you can open up this side of it. This would be considered legging into an iron butterfly if we opened up all 4 positions like this at one time. Robinhood would show you that you had the position open as an iron butterfly, but since you're doing it as 2 separate transactions, it'll just show your call credit spread and your put credit spread separately. But you should be able to grab some credit. So that's why if we take off the top 2 legs, which are, let's see, so there's the calls. You can see it's like right now it's only showing an extra $7, but that's why I was saying, like, you can collect a few more dollars and then just buy shares, just buy partial shares with it as your little trophy. And this is something you could always do a long time ago, but with the position. Yeah, and then so the position that you're in with this, I mean, we all know it's not likely that it's going to plummet $200 and some yesterday, or tomorrow, the next couple days, maybe, who knows, maybe Yellen will say something super cool, or Shopify will be regulated, or I don't know, something will happen. But like, your only potential of actually making money would be that huge downswing, and it would have to like just tipper that. This is like a little bit wider before expiration, but that's kind of your only chance. It's like we were saying, you're pretty much already screwed by not managing it ahead of time. And I've done 100% the same thing. Actually, the worst thing that I did wasn't not managing something. I fat fingered it when I went to open it, and I opened up a debit spread when I meant to open up a credit spread. So I just, like, when I was scrolling through everything, I just looked at it and I was like, oh, okay, well, there's that position, cool, there's that position. And then all of a sudden, when when I actually looked at it, I was like, oh my god. And I was like I was like initially I remember my available balance, or my buying power, didn't change the way I'd expected. Like, it triggered that back, but I opened up completely opposite position, what I intended to. All right, and the reason that you don't need any more collateral, John, for opening up that other position, the other side, is because it can only go one way, right? It can only go up, and you lose on the call side, and it can only go down, then you only lose on the put side. So that's why it doesn't take you any more collateral. And if you already have the collateral out there, they're already holding it, that's the only other thing that you can do with it, besides hope and pray that crazy news will come out. And I mean, we see it. I'm confused why you buy the higher strike and sell the lower strike. Feel like you're speaking another language. Yeah, 100%. I say that all the time. I'm like, options, like learning options, it totally sounds foreign for a while, 100%. But if you just like watch whatever videos and, talk through it, read stuff, whatever, it'll come. Because we talk about, the other problem is, like, there's different terminology. Like, okay, we can say we're selling a vertical, we can say we're short this position, we can say we're writing a put here, we're writing this contract. Like, there's several different ways of saying that I am selling this put at this strike price. But let's see. So you're confused why you buy the higher strike and sell the lower strike. So if this was a position that I was opening today, and when you're looking at that call, that is not something I would do. That's something that John got into, and he did that back when, I assume, Shopify was probably around here, like the 1230, and he sold it $100 out of the money, thinking that's safe. And then Shopify moved up, so that position moved against him. Right now, this is something like, if I was to open this today, it literally, I mean, it would cost nothing to open. Like, it would cost pennies to open, $1, a couple dollars, or whatever. And if it happened to move down there, you'd be jackpot. You'd be, a couple dollars into $1,300, or no, $1,000. Yeah, you'd go from 13 to 1,000. So, but yeah, this is not something that you would open up today. This is one part of it. He opened up probably 3 weeks ago, and then the second part, that's why it's legging into it. And you can do this with something that moves, and you can adjust positions. So if you have an iron condor, you can always move just the call side, or move the put side to adjust for whatever changes you think happen. Can you save this if it goes sour? Well, this what I'm showing you, absolutely, you would not open up this position like I'm showing it right here, right now. Oh, it's exactly what you did. Yeah. So yeah, you wouldn't open up this today. Absolutely not. So like, what you would open up today, I wish there was a way. Can you clear all these at once? So today you would, let's see, can I click on that? Cool. If you were to open this up, most likely this is probably something you would do. If you were to open up an iron butterfly, right? You'd sell a call like right around the strike price if you think it's going to hang out about the same. So you'd sell the call, get your width, maybe there's a $20 width on that. Grab the put side, sell the put. Come on, super slow. So this might be something that you would do. So this is what an iron butterfly should look like. It doesn't cost very much. So you can see it's $2,000 collateral, because we're playing things $20 apart here, and but the credit is 1840. So that means the cost of this is $160, but you can see the max gain is $1,500 if it happens to tip that price. And you can see, like, you know, you can be a little bit to either side here, and you're still making pretty good money. So these are high risk, high reward plays. They're good in the right situation, but when something is super volatile, when it moves $28 in a day, it's hard to pick that center strike price. What was strikes? 1330, 1340, 1320, 1330, something like that. 1320 or 1330, somewhere in there. And John, yeah, I mean, John's in the chat, so I can look. Start asking about this like a little bit ago. It's like, hey, just notice I'm screwed. 1320, 1330. So at that point, like, he would have had to, when he saw it, let's see, I guess I want to see the real chart. Shopify. So when did that happen? Oh, God. Even if you were managing, I mean, I guess you could have kind of closed out a few days ago, but good Lord. That rip up on the 17th, like, you had no chance, like, unless you were literally staring at the screen. What was that? That was from 1350 to 14. That is a massive, massive candle. Those two candles. And what are we at? Like, within an hour, from 1350 to 1430. That's a massive rip. Yeah, and then with the spreads, like, sometimes you're like, hey, let me just, it was an overreaction, but I don't know. But anyways, sounds like my girlfriend's home. I need to go see her, so hate to cut it short. Love you guys. Hopefully that was helpful. If not, shoot me a message, John. Hope you guys have a good night. All right, bye-bye.